Here we'll start with 2019 figures and exploit the 4 options for profitability. Option 1 would be to increase units, let's say by 10%. 10% increase in unit sales will increase sales by 10%. So the new sales is going to be that much. If the number of units sold is increased, then cost of goods sold is also going to increase proportionately. Gross margin will be sales minus cost of goods sold, and if you calculate the difference, it is going to increase proportionately. In this scenario, we assume that operating expenses are going to be maintained at the level same as last year. So here operating expenses will be same as last year. Here what we are saying is that keeping the same cost of operations but using the same resources, we plan to sell 10% more. Cost of operations remains the same. The profit becomes equal to gross margin minus operating expenses, and we see it has immediately increased significantly. Forecasted profit divided by last year profit, and the increase itself is 265%, which is substantial. Option 2 would be to increase retail price by 10%. It's going to still get us 10% increase in revenue. So last year's sales times 1.1 would be the new revenue. Cost of goods sold, however, in this scenario is not going to increase because we are still selling the same number of units but at a higher price. Cost of goods sold will remain the same as last year. Then gross margin here, sales minus cost of goods sold, and we'll see that gross margin increased. In this scenario again, we are going to assume that cost of operations remain the same. So we are not changing cost of operations. We are maintaining operating expenses same as last year. Let's see what the profit is going to be. So gross margin minus operating expenses will give us that much of profit, and that is going to be 609% increase over 2019. Let's explore option 3, which was decreasing cost of goods sold. Decreasing COGS by 10%, our revenue is not going to change. Here we are assuming that we are going to sell the same number of units as we sold last year. We are going to maintain same operating expenses as were last year. However, we are going to control our costs this year. Cost of goods sold will decrease by 10%. So this is going to be last year times 0.9. Gross margin then will be equal to sales minus cost of goods sold. And we see that gross margin increased as compared to 2019 in this scenario. Operating expenses we are keeping same as last year. That will lead to profits of 114.99 billion. This would be an increase of 343% over 2019. So it's still a great scenario. Option 4 would be to decrease operating expenses by 10%, which really at this point StitchFix would need. In this scenario, we assume that we are going to maintain the same sales, same cost of goods sold. However, we are going to control operating expenses by 10%. So let's see what is the result here. Sales is the same, cost of goods sold remains the same, and hence gross margin remains the same. However, operating expenses reduce by 10%, and that will lead to profits just still significantly higher than 2019. Let's see how much higher. That would be an increase of 256% increase in profits over 2019. So all of these scenarios will lead to substantial increase in profit. Now, a company like StitchFix or any fashion business, they would use a combination of multiple options